Yo, what is up guys? Welcome to another video. So if you look into the finance part of YouTube, you see a lot of fear mongering and a lot of like bearish news about the economy and how we're in a recession and all this like scary stuff, which they conveniently tell you after it happens, not before, which makes them seem really smart. And as I was seeing these YouTube videos, which are literally like all over my feed, especially with the recent news about the FTX collapse and the crypto and how the economy, like there's layoffs happening. There's a bunch of news that we're gonna cover in this video, but more than that, I've been actually wondering like, whoa, all this news are here. Everything is bad. Like all these scary news all over the market and all that. And you kind of just listen to these news and you kind of give up on the market and you sell and then you don't know when to get back or you do like most people do, which they have the sunk cost fallacy, which means they want to like, okay, I lost all this money, so I'm gonna try to make it back into the market and try to play like the timing game, and they try to figure out when to get in and out, and it's just they end up in a worse situation because usually when everyone bets in one way, the other thing usually happens. Like for example, with the CPI report last time, the recent one came up at 7.7 or something like that, and like the day before that was literally capitulation. Everyone was getting stopped out. Everyone was like trying to get out of the market. It was really bad. Like I saw my portfolio go down massive, and then the next day the CPI came up at 7.7, and the market literally shot to the stratosphere. And everyone was covering, everyone was chasing after it. You never want to be on that part of the game, because if you're trying to chase things up like all those people did that day, you're gonna miss out on the best market days. Like a lot of people missed out on potentially 700 of the 1200 move total for that day, because it happened pre-market. You can't time that. The algos and computers that literally react to news by the second are doing that, which most of this market nowadays is all computers, guys. So you might do better if you honestly just like listen to, like, you understand how computers work and figure out the pivot points and all that, rather than trying to like figure out with the trading charts and all that. But anyway, today I'm actually going to tell you guys what to do, or when to know when to get back into the market. And I do this in order to set myself at a mental peace point, because I'm more of a long-term investor. I like to believe in companies in the long term and buy until I reach a certain like actual capital point, and then I rebalance my portfolio and I focus on my first three things, which is income, and then growth, and then diversification, or retaining those funds for the long term. Once I got those three things met, then I basically do the same thing over and over again. But this year has been fatal because I don't have a lot of money, as in like compared to like all these other YouTubers or these investors that have multi-millions of dollars. I have a net worth under six figures. That's all I'm gonna say, right? And my biggest focus at the moment, in order to be able to do YouTube or whatever I'm trying to do full time, is to have a source of income, right? And obviously, like I completely skipped the first phase, which is making money, and I just took the money that I have and I just put it into growth. And if you look at growth this year, it got destroyed, like literally destroyed. So my portfolio did not have a good time, and on that entire thing, I did sell around April or so, because I just got so beat up. So I decided to essentially then dollar cost average into the market, and I made like this like pseudo portfolio, which you can see some of the companies here in the TD Phase 1 portfolio that I currently am like dollar cost averaging into. You shouldn't probably listen to me on that. That's just what I'm doing. You don't have to. You shouldn't probably do that. It's just my opinion. But anyway, and when you look at this stuff, like it just gets in your head, because you're trying to like play these games and it just sucks, and it's just a pain in the butt when you're trying to figure this out, right? So today I'm actually going to tell you what I'm doing, and what I do think it's a good strategy to do as to how to fight this current market, which as it is right now, it is actually like it's already been destroyed. Like this is like a dot-com bubble kind of crash, guys. So literally, like, let's go through the news, because this is very important. So last month the CPI came up at 7.7. That's the October CPI, which was a 0.4 point drop compared to the September one, which is crazy, because the September was 8.2. This is 7.7. That's a huge drop, and we're still in the beginning of it. So usually like it is a big drop, enough to obviously cause the big rally that we saw like a couple weeks ago. But we're still in the beginning phases of inflation. So from what I can tell, like it's probably gonna keep dropping over time, but it's gonna get sticky at a point where it's like 5 to 5.5, maybe from 4 to 6. It's gonna be like really tough to get through that point, because there's a lot of like memory from that. Like the gas and the energy and the food and all this is way higher. So that's gonna be the point where, like, if people don't like break, which I do believe that, well, we'll see later, but we're getting close. And when that point breaks, that's when, you know, the official, like, the Fed will be like, okay, we need to start helping the economy. So we're still pretty far ways out, but obviously this is a good thing for the stock market because it means that people are being destroyed. Yep, people are being destroyed. That's good news, right? And obviously, you know, with how aggressive the Fed is going to be, or is being right now, and they're potentially going to be aggressive from now to like potentially early 2023 or something like that. But everything that led to that being aggressive has obviously caused a bunch of news about layoffs, which means that now Amazon, Facebook, you know, all these companies, Twitter fired, oh my gosh, Elon bought Twitter and he basically took everyone out of there. So that's pretty crazy, right? Roku is doing layoffs. A lot of tech companies and even non-tech companies are starting to do layoffs, which essentially means that a lot of people are losing their jobs. Now, one thing they don't tell you is that these are like comfy jobs. Like, this is like office jobs and tech jobs. People basically sit on a computer doing nothing all day. Like the warehouse Amazon jobs, they haven't gone down yet. You know, the jobs about like Meta, it's a high income job. All these people do is they sit on a computer all day and write codes and stuff like that. So, you know, all the like low wage jobs, which are actually what are keep consistently growing year over year, those have not gotten off. It's only the high tech fancy jobs that they're being laid off, you know. But yeah, layoffs are happening, and what this means is that companies are preparing to be shrunk, which means that on the next quarter, we're actually going to see potential pain on the companies, which means that, you know, that's a fundamental bearish sign, which in my strategy, I'm going to show you guys something in the future, which is going to be important. But yeah, layoffs are coming. That's pretty bad. Now, apparently, real estate people can't afford rent. This means that small businesses can't afford paying rent. A lot of credit card, you know, are going to all-time high. This is obviously, like I was saying, that all bearish news, but it is true, guys. There's a lot of bearish information, but you know, there's one thing that you gotta look for the market, and the market is forward-looking. And I would not be surprised that this is somewhat priced in already. I know it's gonna sound crazy, right? It's already priced in. How is that priced in? Well, I'm gonna show you in a minute. But yeah, the biggest thing obviously this month happened was the collapse of crypto, which means that FTX, you know, they declared that they were insolvent. And I'm trying to remember this, guys, but basically a whole bunch of like news about FTX that they were using customer funds and all this, and a lot of big YouTubers were sponsors of FTX, which, I mean, is it their fault? Somewhat, yeah, I'd say it's their fault, but at the same time, like, you know, they're YouTubers, they're in the business of making money. So, you know, if you were the ones that didn't do your research, you're kind of the one that this is kind of your fault. And a lot of them also got burned. Like, I remember some of them actually did believe in the things they were like promoting, and they did have money in them. So, I mean, I'm broke enough that I didn't put any money into these exchanges because, you know, why use FTX when I can just use Robin? Yeah, I'm kidding, you know, but you know what I mean. Like, I wasn't using any of this crypto stuff. I didn't have money to buy crypto at the time, so obviously I didn't care about it. But yeah, a $32 billion company did crash. That's the big news, and crypto is in a extremely bearish. If you look at the technicals, it's in a very bearish sign. So yeah, guys. In order to tell you guys when to get back into the market, right? Well, let's start from the beginning. So if you've read some economics, like the first three things that you gotta look for are the fundamentals. The fundamentals are what a company is, what the economy is doing. So the current fundamentals are that the economy is in an inflationary crisis. There's a bunch of layoffs. There's a bunch of like warnings about people that took a bunch of debt. Now they can't pay it back. And there's also a lot of reported news of layoffs and people using credit cards and all that. So a lot of bearish information is on the economy side, but you got to keep in mind that the Fed is actually loading up on ammunition because they're waiting for something to break. The reason they were so aggressive this year is not because they wanted the economy to go to shambles. That's the last thing they want. What they wanted to is they want to be able to have the tools necessary to prevent a future crisis, which, you know, if you literally like looked at everything on last year, everything was overpriced. So, you know, I do think that what they did is pretty smart. And I do think that what they're doing is actually going to be good for the market in the long term. I know that you probably know about that from all the fear mongering they're giving on the market, but yeah, this is actually going to help the economy in the next 2 to 5 years once everything finally starts correcting and the market goes healthy, because last year was not a healthy economy, guys. That's not normal. Seeing 20-30% growth on stocks, on houses, on cars, that's not a normal thing. That is sign of a demand and supply issue, and also a lot of free money, which obviously is getting now taken out. So, this is good for the economy. So for the long term, actually bullish on the economy. On the short term, you might be bearish, which makes sense, right? And obviously the other side you could do fundamentals of is of the companies that you're buying. So if you're a growth long-term investor like I am, you're probably looking at companies right now that everything's cheap. The issue with this kind of like stock market thing is that when things go cheap, everything is cheap. So, why don't you just go into high growth and just ride those waves? That's what I think. But at the same time, you got to be like, well, it depends on how much money you're willing to risk, because if everything's cheap, I'd rather put it in a company that I know for sure is going to go up over the long term, and not like something that just went up because everything was cheap at the time, No, everything was expensive over the time, sorry. So you gotta do your math calculations correct, right? And you gotta figure out the companies that you know personally of, and make sure those companies have good fundamentals and you believe in them in long term. Be realistic with the short term. Like, how is this like current recession, bad market how is it affecting the company that I invested in long term? And if everything makes sense to you, then I would dollar cost average into it. That's the first part of my 3 factors before I do the strategy. The second one is the technicals, which I'm going to show you a technical strategy that's very easy to do. In fact, I'm actually going to do it right now. So you can see here, I have the trading view. You can use whatever one you want. I prefer trading view because it's so fancy looking. And a super simple strategy that most people do if they're thinking of long-term buying, right? And you're probably gonna, like, people put these in courses and all that. I'm gonna give it to you free. You don't need courses. So one of the most common technicals used by algorithms is moving averages. Moving averages are super important because they essentially give you the average between the certain amount of days. And now those days you do your research, but essentially like it depends on the amount of time and per day, and they did the math over that. But for the short term, people usually use the 9MA and 50. For the long term, which is what we're doing, we're long term investors, not traders. If you want to trade, you can look up somebody else's channel, right? You go for 200 moving average. So the 200 MA on the daily, that's the one that I prefer using. And the second one that I like using for confirmation of the trend is the 200 of the weekly. So I use 200 moving averages. As you can see, this is how it looks. It looks kind of weird, right? But if you want to separate them by color, the daily, I like to make it like a purple color. I don't know, it just looks kind of nice. And the blue, I like to make it like a dark color. It's just way nicer. So now this is what the 200 day moving averages look on the daily and on the weekly. And as you can see here, like every time that it goes above the 200 weekly, like the weekly is a big support. Like if you just take out the 200 day, like this is like historic support, guys. Like 2018, boom. 2020, boom. Even in 2022, it went down and then went straight back up a little bit. And now currently, like it went down and it's bounced off like massive. So the 200 weekly moving average is a strong support, and this is the S&P 500. So it is an index. I mean, normally I don't suggest you trade the index unless you like have $1 million portfolio or using it for option wheel strategy income, but that's a different story. So yeah, guys, like this is a strong, very strong moving average, and every time that it goes under, like not only is it a historic buying point, so you literally buy in at a point of history that you should probably buy, but you're also getting the opportunity to set yourself up for a good dollar cost averaging where it's under that, and then you can just continuously buy, and eventually it'll go back up over it. So I'll guarantee you at least that if it's under it, it might be there for a bit, right? But eventually that moving average will become a resistance or it will become a support. So minimum, no matter how much money you put in there, it will always at least touch it in the future, which is, that's I can guarantee you that with history and with the fact that the money printer is still a thing. It's not right now, but it'll be in the future if things get really bad. So that's that. But anyway, now the reason I use the daily is because I'm impatient, and a lot of traders are very impatient. A lot of investors are also impatient. So I like to use this as a more of a confirmation for, if I should short it or I should buy it. So when it is above it, I literally just like buy it and just hold it. And when it's under it, what I do is I don't touch it. This is my no touch zone, because it just means that I should probably be more defensive. And I think it was about this point, like when this hit this point right here, like in April, May, I actually sold. This is where I got destroyed on my growth stocks. I sold out and I essentially just waited it out. Now, this is obviously this is just my opinion, and it's not my full strategy. If you want to be more technical, there is a better way to do this, and I'm going to show you guys my full strategy, but you shouldn't follow it. It's just what I think it's best, because I like to think of technical analysis the same like a Call of Duty, like gun loadout. Like everyone uses different gun, but the point is the same. You just use it to shoot people in the game. So people might have different guns and all that, but the goal is to do the same thing. That's not what I need. So what I'm gonna do is you basically use the MACD. MACD is historically one of the better indicators for long-term movements. And to be fair, I honestly don't use the signal line or the I don't use the MACD or the signal line. I only use the histogram. And the reason I use the histogram for is because it shows you how strong or how weak a move is. So it's very simple. Or even better, you could also use the Supertrend. Supertrend is super easy to tell if something is in a bullish momentum or a bearish momentum. And this very easy strategy, single-handedly will give you an accuracy on what the market is doing. Now, this is just an example on the S&P 500. If you decide to do it on growth stocks, let's see companies that you believe in, and I'm going to use my portfolio for this. Let's say I believe in Shopify, right? I believe in the long term of Shopify. And well, as you can see here, guys, Shopify, once it went under the 200-day moving average, it became a resistance. This is a huge resistance point. And the Supertrend is bearish, which Supertrend is based on the average 2 range, which is the median range of price according to that day. So it will go up and down over time. Obviously, since it's going down, it's going to go down. And you can see here, it's a very nice form of resistance, right? And if you were me, which I've done it, essentially when I see weakness on the MACD histogram and I see that it's turning bullish here, I just dollar cost average $150 to it. I know it's very dumb because it can keep going down, which it has been, but I'm not in it for the short term. I'm in it for the long term. So every time that I see the Supertrend turn bullish, I just add a little bit to it until I reach my desired share amount. And you could say, oh, why don't you just wait for it to go back up the 200-day moving average or the 200-weekly moving average. It could happen. Look at Netflix, guys. Recently, Netflix has gone above the 200-day moving average, which is a huge bullish sign. But, look at the short term, guys. It went up, and then it kind of got rejected, and then it just played. You're playing these, zigzag games with the market. I don't like doing that. I think that's kind of stupid. Unless you have, a very small percentage of it that you're basically allocating, exclusively to day trade or swing trade, whatever you're doing. I say go for it, but at this, I just don't think it makes sense to try to play this ping pong game with the market. I'm not in it for that. I just want to buy companies I believe in the long term, and I just buy them when I see the MACD histogram turn bullish and I see it turn green on this. I just say, okay, this means that people are buying it and it can't go down any further. Which never say never, but yeah, it means that, for me at least, it means that hey, there's people that are interested in this price point, so I'm gonna keep buying them. And you gotta be careful, guys, because I guess you could wait until this goes above the 200 weekly moving average and then make that move. But what was the last time Shopify went under the 200 weekly moving average? Look at that. A long time, right? It hasn't gone back down there in forever. So, you're buying at historic moments. That's what I'm trying to say. And if you have a vision and you have not a market-based objective, because if you do it market-based, what you're gonna happen is that you're going to get frustrated when you don't see things going your way and you're gonna sell or you're gonna try to buy and then sell. Like imagine if I was trading this, like yeah, I would have been all right here, but then this would have been like, oh yeah, it went bearish, I'm gonna short it, and then it went up here, and then you would have panicked and you would have sold, and then you're under it and you're okay, bullish, play blah blah blah. You don't play those games. I think that's a waste of time. Just stick to the long-term vision. It went under, okay, I'm gonna buy here, maybe 150 bucks, buy here 150 bucks. Oh, it went down, oh, that sucks, 150 bucks, 150 bucks. Obviously, like, do it based on your income and on what you believe in the long term for the company, but you do it over time with companies that you believe in, and you'll get your opportunities. I mean, look at Twilio. I still haven't been able to buy Twilio because it hasn't turned bullish on the Supertrend, so I haven't bought any of that. Baba recently like turned bullish. I should put 150 bucks here. Coinbase turned bullish here. Now it's bearish back again. Affirm turned bullish here, turned bearish again. So if you just do like a very small amount every time you see it turn bullish, you're gonna have your time, because if people were buying it up here, why wouldn't they buy it down here? And now you actually see where people are actually buying, and maybe you're able to join them. As long as you believe in the fundamentals of the company in the long term, you should be all right. That's what I believe in. That's how I'm doing the strategy. It's not a trading strategy. It's just a dollar cost averaging strategy that I came up with that I think is fantastic. Right now here with the S&P 500, you can see that it's playing these like little weird games. Would I add here? Well, I don't have enough money to add enough to the S&P 500, so I don't play the S&P 500 right now. In the future, I'm planning to. Once I have like at least $250,000, I might do some option wheel strategies on this, but you can see that it's weakening here, and it like bounced up this resistance of 200 daily, and it's heading down, but the super trend is bullish, so you probably have to zoom into a different time frame and see how it's behaving. Again, I don't play those short-term games. I just think they're not worth it. But yeah, guys, that is how you know when to get back into the market. Basically, just every time that you see it above the 200 daily and weekly is usually historically a good buying point. And even with crypto, like let me show you cryptocurrency, which is the thing that's been crashing to oblivion. Like this is in 2020, guys. Once it hopped above the 200-day moving average and the 200 weekly moving average, look at the absolutely monstrous move it made. This is absolutely insane. And yeah, it went under. You could have sold and then buy when it got above, but you would get destroyed. The thing you gotta do is you just, whenever you see it like under these two moving averages and you believe in that company, you buy it. And I haven't bought crypto because I'm still kind of scared of what's going on recently, but rest assured, I'm looking at it very closely. And once all of this withers down, I still believe in blockchain as a technology, so that's why I'm buying it. But anyway, I just want to make a video on that, guys. Hopefully it helps you out. Hopefully it gives you an idea of what to do with the market. I know it's a very scary market out there. I know all these YouTubers are like fear-mongering, telling you that everything is going to get worse. And to be fair, things might get worse. You should be defensive in this market. Don't be aggressive. If you're aggressive in this market, you're asking for pain unless you're aggressive to the downside, which, I mean, you technically could short, but at the same time, history isn't against shorts. So yeah, history is for the longs. So you might be able to get away with making money in the short term, but only do it with a percentage of your capital. These people these Michael Burrys and all these like big perma bulls, perma bears, my bad. They talk smack about the economy and how it's all going to crumble, but they only do it with a percentage of the capital. They don't go all into bearish, all bearish mode. They tend to diversify properly, and then that 10% can easily become a 200x on a bad market. That's how you properly become a bear. So let's say you rode this entire historic bull run right here. Like look at this. You run this entire historic bull run, and now you had your 10% hedge, which then you doubled down once it went under here, and you made that's not even enough. That's not that good. But anyway, the fundamentals kicked in. It's super trend been bearish. It went under here. Blah blah blah. You decided to short it, but then you would have done better if you would have just bought this super historic. Look how crazy this is, man. Anyway, you know what I'm trying to say, guys. Just be smart with your investments and believe in the long term. The long term will protect you. The short term will scare you. That's what I think in. Anyway, thank you so much for watching this video. Hopefully, it helped you out, and I'll see you guys in the next one. Peace.